Hi everybody, welcome back. In this video, we're going to sort of pick up where we left off in the last video. We talked about monetary policy, Federal Reserve, banking system, reserve requirements. So in this video, I want to just explain a little bit more about how open market operations work, and then a couple more concepts related to open market operations, which would be the yield curve and inverted yield curves. And also related to that, in today's kind of very low interest rate environment, we have another thing that's called QE, or quantitative easing. And so we'll talk about that as well. But just to start, I want to remind you, so this is way back in the inflation chapter, but I just want to remind you of the dual mandate of the Federal Reserve, which is essentially to promote stable prices and maximum employment. And so what we mean here is the stable prices that they refer to are essentially a long-run average of 2%. Okay, and maximum employment is essentially the lowest unemployment rate that we can handle without increasing prices too much above this target. Because remember, if the unemployment rate gets really low, let me just draw that over here. If the unemployment rate drops, so it's at 10%, and then it goes down to 5%, and then it goes down to 3%, which would be very low. When the unemployment rate is low, how do firms attract workers? If firms need to attract workers, and the economy is doing well, and the unemployment rate is really low, the only way to do that is they're going to have to compete on salary. So with very low unemployment rates, wages increase. And let's even go back a little further. What happens for the market for the goods in the economy? S0, D0, equilibrium price, P star 0, Q star 0. Okay, what happens if income increases? Demand increases. So, if demand increases in the economy, this is kind of the whole domestic market for goods and services. If demand goes up because of that increase in income, the price, equilibrium price, goes up. And what do you call increasing prices? And overall across the economy? Inflation. So if unemployment gets too low, it's going to put upward pressure on inflation. And so we talked about some of the problems with inflation back in that chapter in those videos. So go check those out if you'd like to learn more. So anyway, that's why we have this dual mandate, because these are totally interrelated with each other. All right, and as we talked about in the last couple videos, the Federal Reserve helps do this by conducting all of these monetary policies, which most of the time in kind of recent history involved open market operations. So we're going to talk about those. We're going to talk about quantitative easing, yield curves, inverted yield curves, and so on and so forth. So I talked about this a little bit in the other video, a couple of videos ago, but let's just go ahead and look at it again here. So the money market. This is a special market because the price of money is the interest rate. If I want money, I can go to the bank and quote unquote buy money. That just means if I'm getting money now, I have to pay it back later with interest. So I'm buying money today to return later with interest. So the price of money is the interest rate. Quantity is just the money supply. And as we've talked about, because it's set directly by the Federal Reserve, at any given point in time, the money supply is just going to be a certain number. It's not going to have that standard upward sloping curve. It's just going to be vertical. That's going to be S0. Let's pass the money demand curve through there so that the equilibrium interest rate, which I'm just going to call R, let's call this 1, 2, 3, R star 0 is equal to 3. Okay, so then we'll call this Q star 0. So the Fed, the economy is not doing well. There's risk of a recession. They want to do something. So what do? Federal Open Market Committee, FOMC, they're the decision makers. Talked about it a couple videos ago. They increase the money supply. In doing so, quantity of money in the economy increases. If the supply increases, the interest rate falls. Okay, and so yeah, actually that's the graph. Let's kind of talk about that briefly with some notes. Like I said, the price of money is the interest rate. The supply of money is fixed by the Fed, so the supply curve is vertical, or what we would call in economics perfectly inelastic. And the results of increasing the money supply increases. That means the quantity of money increases. So the supply curve, actually let's leave that out. Supply curve increases, meaning it shifts right, or sometimes people call it an outward shift. I like to think of it as right and left, right for increasing. Supply curve increases, so yeah, then the quantity of money increases, the equilibrium quantity, but most importantly, the equilibrium price, the interest rate, decreases. The interest rate is the cost of borrowing. So the cost of borrowing money goes down. When it's cheaper to borrow, more people borrow. They buy things like cars. That means consumption will go up. Houses or businesses investing, investment will go up, which means that GDP, which is C plus I plus G plus NX, GDP is going to go up. So increasing the money supply through open market operations helps to increase economic activity and stimulate the economy. Okay, now let me talk about yield curves first, but then I want to do a little bit of an extra thing related to both yield curves and open market operations to discuss what we call quantitative easing. So yield curves. To start talking about those, let's think about that we have some money to invest. And I'm going to pose, it's actually a little bit of a trick question, but would you rather invest it in something risky or safe? And it's a trick question because the answer to that depends. And what does it depend on? It depends on the return. If you have a higher expected return, you're able to take on more risk. And so the higher the risk, the higher the return must be in order to take on that investment. Okay, so that's going to be an important part of this. And also keep in mind that uncertainty is risky. So if there's uncertainty about something, then you need to be compensated more for that risk. All right, now we're talking about Treasury Securities. And again, let me just refresh you. Treasury Securities are, the government. This is the United States. They need money from time to time. And when they do, they issue some loans to the general public. I mean, even like a lot of retirement funds that have bonds in them, like even some of our parents, they're going to have U.S. Treasury bonds, which are loans. So you have T-bills. These are short-term T-bills, T-bonds, bonds, bills. I'm blanking on the third one. Bonds, bills. Well, never mind. But Treasury bonds are longer term, and Treasury bills are shorter term. That'll come to me in a second. But the general investing public buys loans from the government, and in exchange, to buy them, they have to spend money. So they give money to the government, and the government is going to pay them back later. The shorter term the loans are, the less risk there is. The longer terms, the more risk there is. So anyway, these are Treasury securities, just loans to the government. All right, and maturity of a loan is the length of time until the loan needs to be repaid. So here we might be talking about something like 3 months even, or a year perhaps. And a treasury bond might be something like 20 or 30 years, for example. So a 3-month maturity or a 20-year maturity, that just means that if it's a 3-month bond, after 3 months, the government is going to pay you back plus a little bit of interest. And for a 3-month, it'll be a very small amount of interest. Okay. Okay. So next step, we're thinking about expectations of the future, and particularly the future of the economy, the future of the country. If the expectations about the future are good, then we have that short-term securities are more certain. Okay, basically, in the short run, things are safer than in the long run during normal kind of good times, right? And so here, when we're talking about short run, short term, again, we're thinking maybe things like 3 months or maybe up to a year or so maturities. And also, during times when expectations about the future are good, longer term securities for example, 30-year government bonds have more uncertainty, and would require a higher interest rate to invest. Because uncertainty is risky. So if it's more uncertain, it's more risky, and it would require a higher interest rate. A higher interest rate to invest in it. All right? So that's hopefully pretty straightforward. But we can have this situation where it's possible that, okay, there's some impending thing, maybe something like COVID-19, and there's a whole bunch of uncertainty, and the future state of the economy is looking bad, right? Are bad up here, are good. Okay, when this happens, if in the short run we really don't know what's about to happen, the pandemic is about to hit, we've got some problems, then short-term securities may become more uncertain and riskier. Let's start with that. Short-term securities may become more uncertain and riskier. Let's do more risky than longer-term securities. And for example, that might happen if there are expectations about a coming recession. Or a pandemic, right? If there's a pandemic coming very soon, we think, then the short term might actually be more uncertain and risky than the long term. Because yes, a pandemic might hit, but that might mean the next year or 2 years could have a lot of risk and a lot of uncertainty. But most likely in 10 years, the pandemic will hopefully be over. So a 10-year investment might actually be safer and less uncertainty than a short-term investment. And so with that, we can actually graph and sort of model the shape of the different maturities, short and long term, and see what this looks like on what's called a yield curve. So let's review this. So a yield curve is a graph or curve that shows the relationship between different interest rates and maturities for securities. It's a graph that shows the relationship between different interest rates and maturities for securities. So usually we're talking about Treasury Securities, those government bonds. And so let's start again with a normal situation where expectations about the future are good. And so what's going to happen is, all right, if we have some three-month loan from the government, in 3 months during normal good times, everything's looking fine. There's almost no risk. So if there's no risk, And let's say 1, 2, 3, 4, 5, 6. If there's no risk, then there's not going to be, I'm not going to get a very high return for that. It's a very safe investment. So I'm going to get a very small interest rate. And so there we have, a very small interest rate. Going from 3 months up to a year, well, that might be a little bit more risky. So if it's more risk, I need a higher return. Same, as we move on up to 5 years, 10 years, 15 years, 30 years. So as we move forward, the yield curve demands a higher rate of return. Because 30 years from now, who knows what's going to happen? There's so much uncertainty, so there's much more risk. So if I'm going to invest in something that's not going to pay me back until 30 years from now, well, I need to get a high rate of return for that. So let's say 5%. Okay, this is, again, during normal, let's just say normal times where we have, nice or good expectations about the future. Okay, now we have the bad times when expectations are not looking good. It looks like we might have a pandemic on our hands or a recession that's coming up, maybe because of a pandemic. And so let's draw that. Now, if it looks like it's coming very soon, then who knows, in 3 months or in 1 year, we might have a recession on our hands. So if I'm going to invest in something that's not going to pay me back for 3 months, and there's a lot of risk there, well, I need to be compensated highly for that. And maybe, maybe I think that it's going to last for less than a year. Maybe I think it'll last, more than a year. But whatever it is, to keep things simple, let's say it's going to be some short-term thing. It's going to be a recession. It's going to hit us soon. So I need to be compensated highly. But after a year, things should probably be a little bit better. After a few years, things will be a little better. But maybe it'll linger. Okay, maybe it won't linger too long. But let's say by 5 years, if we have a recession that hits today, recessions don't normally last 5 years. So yes, I do need to be compensated highly in the short run. But whether I think times are good here with the nice kind of low interest rates, if I think times are good, or if I think times are bad in the short run, I still have no idea what's going to happen in 5 years, or 10 years, or 20 or 30 years. So what happens is we get this inverted shape to the yield curve, and that demonstrates this extra risk in the short run. And I've lost, whoops. Well, let me go ahead and write from the red, we have a pessimistic or uncertain short-term outlook. So bad expectations about the future. And this phenomenon is called an inverted yield curve. And it's got that sort of inverted shape. Let's see. It's got that inverted shape, kind of like a Nike sign almost. And that was 3 months there. So that's an inverted yield curve. And when these things happen, almost every single time across all nations, and it's not fully true, but every time we've had an inverted yield curve in the past, there's been a recession that's followed in the next, say, 18 or 24 months. So it's always inverted yield curves are often harbingers or forward-looking signs of a recession. And in the United States, for the last at least half a century, if not century, every single time we've had an inverted yield curve, we had a recession within the next couple years or so. And that we had an inverted. So actually, I think for separate reasons, we obviously couldn't have predicted COVID even before the COVID outbreak hit in China. There was an inverted yield curve in the United States, and actually, I'm going to show you that here. So this this is not a yield curve. This is the single 10-year Treasury yield over time. So yield curve has time on one axis and the interest rate on another. But that's for different maturities. So a 1-year maturity, 5, 10-year maturity. So this graph below is looking only at this number, but across different points in time. So the maturity here is time in a different way of what we're thinking about it here. So this is actually time. So anyway, the 10-year yield curve, throughout the 2010s decade has been right around 2.5% or so, or maybe a little less. Okay, and the 3-month Treasury yield curve has been quite low, typically drops during recessions, and it was basically at 0 for most of the beginning of that decade. But you can subtract the two, and when you do that, what you're going to be getting is the 10-year minus the 3-month. And so if we look at this here, the 10-year in both cases, let's call that 2.75%. Well, during normal times, the 3-month is something like 0.75. So 2.75 minus 0.75 is 2. And that's a positive number. But when there's some inverted yield curve and uncertainty about the future, now we're talking 3.5%, and 2.75 minus 3.5 is negative. And when that difference between the 10-year and the 3-month goes negative, that is an inverted yield curve. And as I guess I should have mentioned, as I mentioned before, gray bars in this Federal Reserve economic data, gray bars represent recessions. So what do we have? Inverted yield curve followed by a recession. Inverted yield curve, recession. Inverted yield curve, recession. What did we have at the end of 2019 in the fall, actually before COVID? Inverted yield curve. What did we have starting in 2020? Largely due to the pandemic. And so now it's actually impossible to know if we would have had a recession anyway, but we had an inverted yield curve and we again had a recession. So every time in American history, going back for decades, whenever there's been an inverted yield curve, it's been followed pretty quickly by a recession. In this case, the COVID-19 recession. So that's a really interesting point. And so something that people really keep an eye on and help us kind of think about what's going to be happening in the future. The Treasury yields give us signs about what might be coming in the future. Okay, let's see. Let me check my time. I feel like I've gone for a long time. 30 minutes. Okay. Let me pause here. Actually, let me kind of... The last topic I want to cover is quantitative easing for this kind of section. quantitative easing just being another form of open market operations, but it's actually related to this idea of the yield curve and this idea of trading Treasury securities of different maturities, right? And so, but I'm going to hold that off to the next video. I will, though, end by showing a couple, more than a couple, but some review questions that I've been covering based on the last several videos. So if you want to kind of quiz yourself and think about what what the money and banking system is, monetary policy, the Federal Reserve System, these could be some useful things to think about. Okay, so thank you for watching. Really interesting topics here, and I'm going to pick it up with one last video related to this, and the next one on quantitative easing. Thanks for watching, and I'll see you then.